I'm Reuters columnist James Saft. After being a thorn in the side of its trade partners for more than a decade, the yuan now looks like it's turning into both China's currency and China's problem. The yuan's about flat against the dollar over the past year, and the futures market is telling you that it sees it going down in value over the next 12 months. This is a huge contrast over recent years in which the value of the yuan marched steadily upward, having before that been artificially suppressed by the Chinese central bank, which wanted to make Chinese exports more competitive. So why the change? Well, for one thing, export growth out of China is slowing markedly. This is probably being driven by a weak economy globally, but it just means that fewer dollars may be flowing into the Chinese economy in the near future. On top of that, psychology has really changed amongst Chinese consumers and Chinese businesses, which really would like to hang on to their dollars now if they could, figuring that they may be worth a little bit more in a few months' time. This is putting downwards pressure on the yuan and is going to cause huge headaches for the People's Bank of China as it tries to mitigate the impact of a global downturn. For one thing, its balance sheet is growing only very slowly now and may actually contract fairly shortly. That de facto would be a tightening. As well, it faces a real conundrum if it wants to cut rates in order to try to stimulate the economy. If it cuts, it may make the yuan even less attractive to investors and corporations and could speed up capital flight. This is going to make what's looking like a hard landing in China even more difficult to manage. It also may have real impact on the treasury market, where China is one of the big purchasers. There's also a final possibility, which is that as the yuan strengthens, trade tensions go up, and everybody else decides they're not happy about it either. It's going to be a difficult 12 months for China.